Hello, everybody. Welcome back to another Wealth Management Advisory Club. This meeting, we're actually co-oping with the professional development program here at FDU Silberman. Today, we have a very, very special guest. We have Valley Bank. I'm not going to be introducing them this time. I'm actually going to have our advisor of our club, Professor Koza, introduce them. Please give your undivided attention. Please ask a lot of questions. And there is food here if anyone wants it. Please do. And Koza, I'm going to let you take it away then. So.
Okay, great. Thank you, Jack. Good afternoon, everyone. Thank you for joining us. For those of you that don't know me, I am Patrick Koza, Executive in Residence for the university and also professor. You have had me in the classroom and you still do. And the other part of my job is actually working with great companies like Valley National to get our university closer to them in a variety of ways. Certainly the most topical way is opportunities for our students, but there's many other ways that we can help Valley National be better at what they do through our education processes, etc. And we had a great opportunity to start the relationship with Valley National back last June, where we did a Silberman symposium on campus. We had some of the senior leaders from Valley at that event, and then we followed that up in September, where we did our annual Silberman Gala. And at that event, we had some of Valley's senior leaders attend, and two of those were Chris Brigati and Peter Belasco, who I had the opportunity to meet at that event. Christopher is a senior vice president of managing director of the municipal investment area, as is Peter. And they were very excited about coming in to talking to you all about what they do and how you might want to consider a career path in those areas, or just pick their brains a bit as to what's made them successful at their time with Valley National. We think a lot of Valley National and Fairleigh Dickinson. They're in the process of moving their operations to Morristown. It's going to be that much closer to our Madison campus. And so with that, I would like to welcome both Christopher and Peter and just turn it over to you, gentlemen. Thank you again so much for coming and doing this.
Thank you. Thank you very much. Thanks for having me, everybody. Very excited to be here. Peter is back at the office. Somebody had to stay back to make some money for us, so I came out to do the presentation. As was mentioned, I have a long career in the financial services industry. I spent 20 years at Morgan Stanley, and I actually ran a bond trading desk there for about 8 years of my tenure. The interesting things with that is understanding how the markets work, understanding different machinations within the business. And I specifically worked a lot with the wealth management teams over my career in various capacities prior to running the desk. Running the desk, we managed about $1 billion in capital risk. Made about $500 million in annualized revenue, and the committing of capital and making those kind of commitments for the entity were really interesting, challenging. And presently, we're at Valley Bank. We're running a bond arbitrage desk for the bank, so we're basically trying to buy and sell bonds with our knowledge, understanding, connections, et cetera, in order to be able to make revenue and figure out ways to drive business. It's not forwarding. Okay. Agenda, some of the things we're going to talk about today, I'm going to try and relate as much of this I can as to wealth management business, since that is one of the sponsors. Wealth management client demographics. What are wealth management clients like? What are the demographics? Some really basics in there. Nothing really too deeper involved. I'm going to talk about the bond markets, and that's what I do. That's what I've done for most of my career, with a little bit of focus upon municipal bonds. Part of the reason for that is wealth management clients generally enjoy the benefits of the municipal bond market. So we won't go too into detail on that, but I just think there's some interesting points to be made. Some changes that have happened in the wealth management business over the years. Offer a little bit of career advice and some homework for everybody. Don't worry, that's easy. It's fun too. One of the questions is, how does being a car mechanic relate to wealth management business? I'm not a car mechanic. I know very little about cars. I could probably change an oil in a 1975 type of vehicle if that was presented to me. The basic premise, though, is what did I do and how could I relate to be able to avoid having these kind of problems when trying to engage people in client demographics? The reason I bring this up is because I was in front of a very wealthy client, had about a $50 to $60 million bond portfolio earlier in my career, wealth management client, obviously. And it was shortly after 2001 World Trade Center attacks, shortly after 9/11. He was very scared and very concerned about dirty bombs, which have made the press again lately, which was basically a conventional bomb with radioactive material in it, which if the bomb goes off, it spreads, it decimates an area. It's obviously very bad. So he was very concerned about this, and he was telling me what he needed to do to fix his bond, to not fix, there was no problem with the bond portfolio, to manage his bond portfolio. He wouldn't listen to me, he wouldn't take my answers. I got to know him over a period of time. He was a bit of a car enthusiast. So I couldn't get through to him. Finally, I figured out a way to get it through to him. I finally said, what kind of car do you drive? What's your day-to-day car? What do you drive around? What, just to get to and from work. Didn't understand why I was asking. I said, just humor me here. It's a Mercedes 500 SL or something. He's very proud of his car. It's a great car. I told him, let's say you're driving down the road, you have a problem with the car. You got to take it to the dealership. Do you walk in and tell the mechanic, I need a new engine? He said, well, I don't know anything about cars. Why would I tell him that? I said, well, what do you know about municipal bonds? What do you know about the bond market that I don't know? This is what I do 10 hours a day. I've been doing this for years. You're a genius at what you do, I'm sure, which was something in medical supplies or something. I said, but listen to me when I'm talking about what I need to tell you to do. I'm relating this to something that he cared about, which was his cars. He was a car guy. He understood. He finally said, I get it. I said, you could go in and tell your mechanic, I need a new engine. Mechanic's going to tell you need a new spark plug. Just save you about $50,000. I said, I'm saving you a lot more than $50,000 by listening to my advice, telling you don't panic sell into this market. You're going to be taken advantage of by anyone else in the market. If you're really concerned about it, we can work something out. But he ended up listening, taking a breather, holding pat, and we worked through it. In the long run, he held on to his bonds. He did very well in the long run. But I think that's a relatable story, so I wanted to convey that. Nothing really compelling here. Different demographics for within different percentiles for wealth management clients. Obviously, wealthy people have money. These are in thousands of dollars. So the lowest quartile tax bracket of net worth in the United States is up to $12,000 of net worth. Obviously, if you're going into wealth management business, you're not going to go after that target market. They're not going to really help you very much. So we're gonna focus on the larger part of this. So these are just the 75 to 89.9% and the 90 to 99%. We're looking at 400,000 to 1.2 million in assets. These are net assets, investable assets in terms of net worth, or 1.2 million to 11 million in investable assets. Those are the client demographics that are generally considered somebody a wealth management advisor would pursue. Why is this relevant? A lot of data here. Just look at the lower left corner of each one of these. The mean financial assets by percentile. I just picked the higher groups. So they have that highest group has between 1.2 to 11 million in net worth. The percentile that they invest in the financial markets is, it's hard to read, 2.8. So obviously that's enough money if you're going into financial services to be able to help them, you to be able to have a career for going after those kinds of clients. The next step is what percent do they located in fixed income? Fixed income assets are anywhere between 35 to 45% of their total net worth assets. So they have meaningful assets in fixed income. Fixed income is a wealth management asset class that people enjoy for the obvious reasons. There's tax benefits involved. It's a generally safe product. They have other assets in equities and alternative assets and real estate, what have you. But the focus of this was just to provide a base and understanding of some of the demographics for the very wealthy people. Why fixed income? I kind of touched up on this a little bit. I actually have video of an equity person, and I want to just show this. This is what we think of equity people in fixed income. This is a typical equity person. It's a monkey. We make fun of them. I have a lot of friends in equities, but it's just to bust their chops, just to have a fun time with them. The point of this is fixed income doesn't have the sexiness. It doesn't get all the play that the equity markets do. People don't think of it the same way. But there's a lot of benefit and there's a lot of opportunity in fixed income. So what is a bond? Really simple, it's a loan. It's basically a loan from one person to another with set parameters including maturity date, interest payment figures, and when some call features could be introduced and some various machinations that could change it. A municipal bond is basically the same thing, a debt from a municipal entity. That debt could be Fairleigh Dickinson University, a public institution. It could be the town of Madison. It could be the state of New Jersey. There's all sorts of different entities that really comprise the municipal bond market. A little bit of bond history. First recorded debt instruments were very long ago, 2400 BC. Clay tablets. Funny thing is, I did a little research on this, that there was listed the consequences of not paying the debt. I don't know what those consequences were, but given that it was ancient Sumeria, it probably wasn't anything very good. The concept of municipal financing started in the 14th century with the Italian Renaissance. That was basically city-states were borrowing money from wealthy individuals to fund their operations. The bond market. It is a decentralized over-the-counter market. So it is not like an exchange. You don't go to the Wall Street. You don't go to the New York Stock Exchange. It's decentralized. Everything takes place over the phone or instant messaging or some other sort of messaging back and forth between people. We do a lot of our business directly on a phone with people we've had relationships with for a long time, or people that we've never even met. We do trades every day with people we never meet. Reputation and relationships are extremely important. So reputational risk for the individual doing the business is relevant for that. Municipal bonds 101. What's interesting about municipal bonds? They're exempt from federal and state taxes. That's why wealthy people like them. Trust me, wealthy people do not want to pay taxes. It's this guy that had the $50 million portfolio in New York credits. All he cared about was avoiding paying taxes. I said, if you take some of this money out, you're going to pay some capital gains on this. And, whoa, wait a minute. Now we're changing the story a little bit. He didn't want to have that conversation. Most are also exempt from local and state taxes. So exempt from New Jersey state. The New York bonds were exempt from New York state. Generally, the bonds are exempt within the state in which they are issued. There's exceptions to that, but as a general rule, that's what most of them are comprised of. And there are a lot of nuances regarding the municipal bond market. It's a very complicated market, despite the fact that it's not fun and sexy like equities. But there's a lot of little things to know, and that presents opportunity for investors, presents opportunities for people like us, which are doing arbitrage in the market, to find opportunity to get in between the weeds and really kind of dig in and find where we can make money. The entire domestic debt market is about $53 trillion. So that includes U.S. Treasury, mortgage backs, U.S. corporates, and municipals. As you can see, municipals are a fraction of the other markets, very small in size. 18% of the U.S. Treasury, 34% of the mortgage backed, and about 41% of U.S. corporates. The number of issues, this is where it gets complicated. There's one credit in the Treasury market, that is the U.S. government. Very simple market from a credit perspective. The most liquid, the highest rated credit quality in the entire world is U.S. Treasury debt. There's about 5,000 corporate bonds in the market that trade hands actively. There's about 60,000 individual municipal bond credits. I've been doing this for a long time. I have not traded every single one that exists. I've never seen probably more than 60% of them. A lot of these go away into somebody's hands and you never see them again. But there are some opportunities in there to find value and drive revenue. Within that, there are over 1.7 million unique credits. So the municipal bond market, they issue bonds. Typical offering will include about 20 different bonds within an issuer credit rating. So understanding how those break down in the structure of them is really important to understanding the opportunity. Capital preservation is key. This is one of the keys of the municipal bond market, why it offers value. The default rate is extremely low. 0.08% of the entire municipal bond market defaulted over a 5-year cumulative history. So from the beginning of a credit rating, 5 years after, 0.08% have defaulted. As you can see by this, when we're looking at comparable to global corporates, there's a big difference. A little over 10% of the corporate bond market defaults. If you're looking at a higher credit quality rating, where these wealthy individuals that are in the wealth management space want to be involved, you're looking at 0.04% default rate and then 0.86%. So still, really small for global corporates, but municipals are extremely lighter. There's very limited credit risk over the past 50-year time horizon. And if you're looking in the municipal market, what kind of credits are the problem? You're looking at hospitals and healthcare and housing. Those are where the defaults generally happen. So as an investor, avoiding those things is key. It's important to avoid where you can have default risk and avoid the challenges. Ownership of the debt, 41% is generally in individual hands. The other 28% that I'm referencing there to get to the total of 69% of outstanding debt owned by individuals is in funds or such vehicles. So the municipal market is unique in that it is highly driven by the retail investor. So a wealth management client is a very involved person in this market. The size of it, the opportunity in it, the value of avoiding taxes is what makes it enticing, as I mentioned. But the fact that they are so actively involved and so heavily invested, meaning retail flows drive the market. Think of it economics 101, what affects prices in a different market. Price goes up as demand goes up, price goes down as supply goes down. Those two offset and affect the market. Well, this demand and supply component, given the retail investor, the wealth management client, is important. What are some key takeaways for this? Wealthy investors have meaningful investment in fixed income products. As we kind of discussed, there's a value proposition for the investor, and what do they want out of it? One of the key things is they want return of capital. They want to make sure their money is safe. They want to get the capital they put out in the market back. And the wealthier they are, it's more about building a base, building an opportunity for them to grow wealth. They have wealth that they don't want to lose. You want to make a client smile, give them back more than 60% of their money. Don't let taxes take away some of their opportunity. Kind of as I showed with that slide with the monkey, fixed income professionals are smarter, better looking, and we're a hell of a lot more humble than equity guys. So, looking at people that have been in the movies, Ryan Gosling, really handsome guy. He's in one of the big movies, The Big Short. He was a fixed income guy. So that's our reference point. I can't think of any equity guys that have mattered in movies, so we ignore them. Municipal bonds, tax advantage products. We discussed that. They're high credit quality and they're very complex. Those different factors that affect them, 60,000 credits, 1.7 million different bonds that exist constantly, with all sorts of different call features, all sorts of different credit profiles. These things affect the market, and how can you figure out how to drive business? Some changes to the wealth management business that we've seen. Going forward, an individual is going to have to manage clients through a bear market. We've had a bull market in equities and fixed income for the better part of the past 20 years. We're finally reaching a point where this year it's the worst bond market in the history of the bond market, dating back forever. It's kind of unusual. It's a painful experience. Managing a client through that is a real challenge. I had a conversation with a client the other day who had put some money into the bond market, into mutual funds, and thought he was being safe with his money. He's got net asset value decreases. He's lost some capital in the process. And his contention was, I thought it was safe. I thought it would never go down as well. It's a capital market product. It can lose money. So being mindful of that, but helping people understand before they get into that situation is key for individuals that are pursuing these kind of careers in wealth management. The rise of family offices. So this is really interesting. The ultra wealthy have started to do these things where they bring in their own advisor who might have been an advisor at Morgan Stanley or Merrill Lynch or Citibank, and built up a very good practice and a very good opportunity for themselves. Some of these ultra wealthy individuals actually hire that person to run all of their family money from soup to nuts, whether it's investing, whether it's managing real estate, managing downstream for heirs. There's all sorts of opportunities in that space, but building a good practice in wealth management was one of the keys to being able to allow these people to drive for this opportunity. But it's really growing a lot. It's really an interesting space. And when I'm looking at people in wealth management, one of the keys is understanding what are their goals in terms of their family assets. And the more you think about the family assets, the more these family offices come into play. There's new products involved, crypto, NFTs, all sorts of digital assets, really fun and exciting. But, again, I drive back to the point of these wealthy people that are in wealth management, they want to preserve their capital. So it's really good to be able to have those conversations about NFTs, have conversations about different assets, get involved in equities, alternative products. But that core base of something in fixed income is really important. And like the gentleman I referenced in the beginning with that car story, he didn't know anything about fixed income. So he had to rely on the expert, which was me, which was why I'm in those conversations with them. There's going to be a big wealth management. So I run all my businesses with a lot of data points behind them, and wealth management, there's going to be a transfer from baby boomers to their children of their capital in the coming years. It's already been happening, but it's going to start accelerating. So, as a new individual pursuing such a career, knowing that demographic, like how are you going to be able to target and have a plan to go after those clients and those potential clients, the baby boomer children. Some other stats I saw were that the children of the baby boomers are not necessarily keeping with the wealth management advisor that their parent had used. So understanding that you as a new individual getting into the space, pursuing such a career, having having a relationship with that child when they eventually get those assets is going to be helpful. And 44% of advisors are over 60 years old. So it's an aging demographic in the space already. I have a lot of friends in the wealth management space that are advisors at various firms. They started out as a young apprentice underneath, a relatively senior individual. Eventually that individual transfers on, moves on, retires, what have you, passes off their business to the virtual apprentice, the younger person in the business who's been training under them and working with these clients. And so it's a very seamless operation. You might have to buy out the advisor in terms of buying the client base. Sometimes there's some sort of a wealth sharing situation afterwards where you keep paying revenues that are earned on a go-forward basis for the next several years to that prior advisor in order to monetize them for essentially selling you the business. But the fact that there's an aging demographic in the space of workers and employees in that space is something to be mindful of. Some of the career advice: differentiate yourself as a solution to clients. That's that was the point of my story in the beginning with the car mechanic thing. It took me a while to get him to understand, but I was the differentiating factor for that gentleman. I was the expert in the space, and it took me a while to be able to convey that message to him. But how can you do that going forward for yourself? What can you do? And having expertise in an asset class that might not be the most fun and exciting, but it's really going to make them happy, save them money, allow them not to pay a ton of taxes, is going to be something that you can do to drive your career going forward. Work ethic. Work ethic can't be taught. I went to SUNY Albany. I didn't go to a big Harvard or Yale or anything, exciting like that. One of the things when I came out into the business originally at Morgan Stanley on Wall Street, one of my bosses said, I'd rather have 10 guys that went to SUNY Albany that didn't have a silver spoon in their mouth, but have the hustle, have the work ethic. They want to work their ass off, basically. I think a lot of people in this room and a lot of people at, the second tier and the third tier type of schools like SUNY Albany, like Fairleigh Dickinson, you're going to come out with a little bit more hustle than the next person. And that's a good thing. And it's something that can't be taught. And to get something you've never had, you have to do something you never did. I'm going to say it again. To get something you never had, you have to do something you never did. Work ethic is going to get you there. How can you figure out how to use that to your advantage, and how can you differentiate yourselves is one of the keys. This is one of my favorite sayings: whether you think you can or you think you can't, you're right. Henry Ford. Think of it. You just gotta believe in yourself. You gotta invest in yourself. You're doing it right now. You could be working somewhere full-time, earning money as a career. Instead, you're investing in yourself going forward by going to college, spending the theoretical work hours you could be doing by going to school, learning more, advancing your opportunity to better yourself professionally, becoming a better value-added product to a potential employer. And if you aim at nothing, you'll hit it every time. Have a plan. Figure out where you're going to go next. Sometimes it's a daily plan. I have a daily plan every day when I go to work. I don't always accomplish everything on it, but I know what I want to do. Some of those things I have to do. I don't have a choice. How can you do that going forward? What are you doing now that's going to set you up for your future? Participating in this club is an example. What are you doing next month? You getting resumes out there for something if you're at that stage where you got to start looking for the next job? Those kind of things are important, and they're basic, but people forget them all the time. Here's the homework portion. These are a couple of books. Fixed Income Securities by Frank Fabozzi. It's like a textbook for anybody that's been on the bond market and on a Wall Street trading desk in fixed income. The fundamentals of municipal bonds. It's not a good read, but it's got a lot of good information in there. Too Big to Fail. I worked for John Mack. He was the CEO of Morgan Stanley back when the credit crisis happened in 08, 09. I was running the bond trading desk back then. Really good book, really good movie. So, I recommend both of those. I'd read the book first, as they always say. It's usually better. You'll understand a little bit more. It's a little deeper, a little more involved. The Big Short. I mean, there's so many little nuances. I can watch that movie 10 times and pick up a little something's kind of, I've seen in my career, or something cool or funny or, what have you. But that's an interesting one. And a lesser known one is Margin Call. That was kind of surrounding, a similar situation to the credit crisis. And understanding what's going on in Wall Street, what's creating those crises at a given point in time, and how are people managing through them. But sometimes it's just the visuals of some of those movies, seeing what people are doing, seeing the Bloomberg screens, seeing what they're doing when they're in a high level meeting. Those things, they're really kind of true to form. I mean, I've seen every single thing I've seen in some of those movies is one way or another has happened to me, or I've observed in my career. So those are all some a few interesting things. We're coming up on about a half hour now, so wanted to open up any questions. I'm open book. Ask me anything you want, market wise, bond wise, career wise, what I'm doing on a daily basis. I don't care. Go ahead.
Is there a lot of traveling for your job? I suppose probably not. I know phone calls.
A lot of phone calls, for those online, the question was a lot of traveling involved. Not for me personally, depending on what you do. I mean, so I ran a bond trading desk. I'm currently running an arbitrage business. I've kind of got to be on the desk in order to make money for what I do. If you're going into a wealth management role, there's probably a little bit more, going and visiting clients, going into Art Basel down in Miami and kind of trolling for clients, finding opportunity. It just depends. I do events like this occasionally locally. I've traveled down to Florida to speak to clients and potential clients of the bank. I do a Bloomberg TV segment, so I'm on that once a month or so. Different things where I'm kind of going around. Some are locally, like going in the city for Bloomberg is an easy one. But earlier in my career, I probably traveled a little more. Depending on what you're doing, you can kind of target your career whether you want to travel or not. There's different roles within that. When I first came out, I thought I was going to be in credit analytics work. Interesting here. I'm going to segue into this a little bit. When I was in school, I remember, I think it was late junior year, I was in one of my advanced finance classes, and we were talking about a project we had to work on where there's about 35-ish students in the class. And the professor gave us an assignment. Everyone was talking about equities. Equity was the only conversation that happened. That was when I decided, let me figure more about fixed income. How did I differentiate myself to a future employer? I wanted to come out and say, well, I know more about fixed income than anybody else you're going to talk to, because I targeted it in my studies. I targeted it in my opportunity set. I looked at different things that might have helped me in that regard. So then when I came out, I started doing a little bit of credit analytic work. I had an opportunity to get on a bond trading desk, and I loved it. I mean, it's I hate to say glorified gambling. I think people sometimes refer to it like that, but making a bet, making an investment, making a trade in the market on your own personal, thoughts and considerations. I remember the first bond I ever traded. I mean, I remember to this day, Hoboken, New Jersey, 4% of 2007. They've since matured. But that was the first bond I ever traded. It was kind of cool. So you can steer your career the way you want to. If you want to be in travel, you go in with that mindset. You look for, opportunities going to present that more. It depends on what you really want to do. Anybody else? Sure. That's a hard one. That work ethic comes into play. For myself, when I look at, how did I do it? Like I said, I came from a very, very middle-class upbringing in upstate New York, Syracuse. So I wasn't even Westchester. I say, well, upstate New York, people are like, oh, Westchester. Like, no, further north, colder, more snow, not fun. I moved down to New York after college, and I put myself in a situation to succeed, and I invested in myself. And I was eating tuna fish sandwiches 5 days a week, which I hated, but it was cheap. So, when you're looking at what can you do, are you asking for yourself or just in general, kind of for yourself? Okay. So where can you start is anything you can save, and you can start very easily start like a Fidelity type of account, start investing in the market, start, put money into long-term type of opportunities. And you're young enough where equities are the only way to go. You don't want fixed income when you're your age. First of all, it's not worth it. Second of all, the cumulative effect of the growth of the asset in equities is huge when you're in your, younger than 30 demographic. So putting that in and having a plan, doing it methodically and periodically. 401k plans, once you get into an employment situation and you're working, is a really great vehicle. I've got a lot of wealth in my 401ks just because I've done it since I was fresh out of school. Well, not fresh out of school. I had to eat those tuna fish sandwiches for a while. But once I was able to start squirreling it away, I did. And the benefits of those things are compounding and cumulative, because you're going to get usually some sort of a match from the employer. It's different, but first 2,500 to could be 100% match up to the maximum, which is rare, but it could happen, of your monies you invest, which is pre-tax. So you're taking money out of your paycheck, you're not paying tax on it, and you're putting it into a 401k. Easy again to do with a Fidelity type of account, or I keep saying that because that's who I have with one of my 401ks. But they're very easy, they're relatively cheap, and it's time in the market, not timing the market. So you start early, you keep the capital in there, it'll grow over time. The compounding effects are astronomical. Here's another career advice: Excel spreadsheets. Get good at Excel. I ran $1 billion municipal bond business at Morgan Stanley on an Excel spreadsheet. There were other vehicles within the bank, the investment bank, that I had to look at, but when push came to shove, I knew what I wanted to do based on my Excel spreadsheet. And it was relatively simple given the size of the macro size of the business. But you can do something with an Excel spreadsheet where you could just do a compounding effect. Say you're going to save $1,000 a year for 10 years, $1,000 plus another $1,000 plus another $1,000. Well, that first 1,000 is going to be compounding. You pick your compounding rate. It's around 7 or 8% annual compounding S&P rate for the past 20 years. Use that as a guide. And you can see that first $1,000 is going to be worth a lot more money. It's going to more than double in 10 years. So your first 1,000 is going to be worth more than 2,000, probably more than 2,500. Your second 1,000 is going to be worth more than 2,000. Next thing you know, you've really put in $10,000, but in 10 years, you're going to have north of 30. And you can really kind of demonstrate that with an Excel spreadsheet. I did that for a friend of mine, caddy at my golf club. He was asking how he can do something like this, and I showed it to him in a spreadsheet. So how much can you save? What can you do? And then eventually you're going to start making more money. You're going to be able to save more money, and you can max out your 401k. It sounds basic, but scrimp and save where you can. That's how I started personally. Go ahead.
Given your experience like previous market crashes like the 2008 crash, do you notice any similarities with the current market? And if there are any similarities, do you have any advice for us to prepare to maximize on this discussion?
Yeah. Question was similarities between the 08-09 credit crisis and now. The big difference, I'll go with the differences first that I see. The big difference with the 08 credit crisis was that it was very liquidity driven, meaning that the market participants decided they all wanted to exit at the same time. Let's say, we have 10 more, or maybe 100 more people in this room. That door is the only door out. Somebody yells fire. Everyone wants to run for that exit at the same time. Well, not everybody's going to get out. And not everybody's going to get out in a good way. You're going to get banged up as you're doing it. The credit crisis in 08-09 was similar to that. It affected housing. Housing was a big challenge with that. That's not a current problem. I foresee housing going down. I think it's going to get cheaper to buy a home sometime in the next 2 to 3 years. Housing prices were very inflated of late. But in the credit crisis, it became easy to get money and easy for people to borrow money. Credit standards went down. So people were borrowing no interest loans, multiple houses. Suddenly the credit crisis says they can't pay their one mortgage, let alone 2 or 3, et cetera. We're not seeing those kind of things now. And the liquidity issue, meaning everybody wanted to get out that same door at the same time because they wanted to sell their assets all at once. Well, that created a huge downfall in the risk markets, the equity and the fixed income markets. It bounced back relatively quickly. There wasn't a lot of credit downgrades, as it turned out, in terms of the bond market or the corporations and the equity market either. But the challenge was a little different. Similarities between then and now. There's 4 categories of things. And right now, to me, the biggest question is the unknown unknowns. You don't know some things that you don't know about it. Nobody does right now. You can kind of bucket things into, well, I know some things that are wrong in the market right now. I know some things that are wrong with the economy right now. On my way over here, I was listening to Chairman Powell speak with the Fed because they just raised interest rates, the Fed funds rate 75 basis points. That was fully expected. It was baked into the market. It was understood. The real key was, what was he going to say going forward? One of the challenges now versus 08-09 is the Fed is much more active, much more involved. I wish they wouldn't talk as much as they do. It drives me nuts. Every day, as long as they don't have a blackout period where they can't talk before the Fed meeting for a period of a week or so, somebody from the Fed is speaking somewhere in the world, saying something that's just going to annoy me. Because they're not adding value to me. They're posing possibilities that could exist. Well, possibility could exist that a meteor is going to come in and wipe us all out in the next hour. It's a low possibility, it's a possibility. But if a Fed governor gets up and says something similarly insane to the market, some market participants start to say, well, he said it could happen. So now I got to factor that into my analysis and how am I going to process that, et cetera. So when they're talking, they're much more active, they're much more involved. I don't think they add a lot of value when they do that. And that's a big difference between then and now. Back then, the Fed acted when they acted and they didn't act when they didn't act. And you didn't hear from them multiple Fed governors every week. So the data out there is a big difference. To prepare for it, read, study, look up. Probably not the same now. Back when I was just starting out, I got a Wall Street Journal subscription just to be able to read something. And I started reading the fixed income. There's certain parts of it that talked about fixed income. And I would read those sections every day. Didn't know what they were talking about half the time. I started absorbing the information. I'd ask colleagues, I'd ask somebody that did know. There's resources out there that you can ask and you can have that conversation and say, I read this, I saw this, whether it's somebody like me, a professor, a friend, a colleague, another student in class, somebody might be able to shed some insight. So ask those questions, but figure out a different way to learn something to add value to what you're doing. And something could be as simple as reading, go to a publication or a post that you enjoy, pick up this Fabosi book, take a look at what's in there, see some of the interesting things you can read. Watch those movies, they're good. Yeah.
Northwestern Mutual came out with a statement saying if you're 64 and you have $1.25 million, that's enough to retire. I want to know, do you agree? Why or why not? And I'm also going to tell you that John Budish, who runs Markets Update, gave this challenge to our students and said, if you believe this is true, tell us how to come up with a plan. You're 64, you have $1.25 million. How will you invest that, and is it enough? So what's your opinion? My opinion
is that's not nearly enough. Not enough for me. I like to golf. I like to travel. I like to have fun. I like to go out to dinner. Those things cost money. I live in an expensive area. I live in an expensive house. I have a wife that spends money. I have kids, not in college yet. That's going to be an expense. You know, somebody could. There's plenty of people that live on way less than that in their retirement. Depends on the lifestyle you want to lead. When I started out my career and I started working, I thought I'm going to work my tail off for a period of time. I was the first guy in, the last guy out at Morgan Stanley trading desk for I don't know how many years. It's exhausting, but you know, putting in FaceTime and some of that, it kind of matters. Having the work ethic to do that matters. But I said to myself, I'm going to get to a point where I can earn enough money where I can enjoy the retirement that I wanted to enjoy. I want to go play golf. I want to travel. I want to, you know, I want to do things I don't want to do. I want to have a comfortable lifestyle. I don't want to have to be 69 and eating tuna fish sandwiches. That's not going to happen. So I don't think it's enough. You know, could it be enough if you move to, I don't know, Iowa, maybe? For me, it's got to be at least, for me, it's higher. I'd say for an average, I'd probably say it's somewhere between 5 to 7 million. That's the number I use. My number's a lot higher than that. That's why I'm still working. But the compounding effects of the 401k, you can get to $1 million too if you start saving a 401k when you're in your mid-20s. You can easily get there. Yeah.
Like the biggest thing is that they say invest in mutual funds, and then you mentioned that get the compound interest, like having enough money to retire. Is there any like advice that like maybe some riskier investments that you could do to get like that wealth out of your age?
Yeah.
The big thing like real estate, but like
I mean, it's funny with real estate, that's interesting. So my wife's a dentist. She owned her own practice. We bought a building. We had a tenant in the building that rented an apartment in the building. She had her dental office in there. Within the past 2 years, she sold her practice, decided she didn't want to do it anymore. She's freelancing and doing some other stuff, doing Botox and other stuff that she wants to do to shoot people up. I don't know, that's fun for her, I guess. But we had that real estate investment ourselves, and it was about an hour from my house. We decided we're selling because I didn't want to be a landlord to two tenants in a place a ways away from me. If you get into the real estate game where you're buying something and, you know, not the flipping house game, which is a lot riskier, but doing it in terms of an investable asset, buying something that's affordable, making it nice enough for people to live in, getting some tenants in it, adding onto that over time by adding more people, more houses is, you know, a very, I don't want to say easy, it's a lot of work, but it's a very doable way because you're compounding and paying over time because you can get a good interest rate mortgage. Not nowadays, interest rates are insane. I wouldn't recommend trying to take out a mortgage right now. But generally speaking, you know, there's opportunities there. When I look at macro trends, I think I've always kind of played the market a little bit with my personal assets in terms of I had a certain amount of assets, and I learned this from a gentleman, wealth management client, different guy. He had about 100 million. He started his company. He sold it to Microsoft. He netted about 100 million after taxes. He had about 50 million, and he came in via his financial advisor and said, you know, me being the fixed income and the municipal guy for him to contact, you know, Brigati. I went by Brigati too. It's my partner on the desk was also a Chris, so to differentiate, we just went by last names. So he just said, hey, Brigati, this is $50 million that I worked my tail off. I was a regular guy, built a company out of a garage. You know, he ate tuna fish sandwiches too, oddly enough, just to be able to get by until he built his business, netted 100 million, netted 50 million after selling for 100 million to Microsoft. He said, this is my FU money. I don't want to lose it. This is my FU. I'm not gonna go down. I want $50 million at the end of the day. So how are we going to do that? And what are we going to do to preserve that capital and preserve those assets? We put it all into some municipal investments for him, direct bonds, avoid mutual funds for municipal investments. They don't work for individuals. You need it in the beginning because you can't afford to build a portfolio as an individual in municipal bonds, but you're not doing it at your age anyway. But we put it in the market, and then once we got him a decent amount of return on that, he decided he wanted to take some of that money and he wanted to just play the market. And he did stuff that he wanted to do with some of that capital. He took, just wild bets, wild risks in different various ways. And one thing he did, I remember he told me one thing he did every day. It's like he'd look at the S&P index and he would buy the S&P index or sell the S&P index every day just to do it. If you look for macro trends within those kind of things, do charting analyst work. I'm a chartist. I create my charts. I look for patterns. There's 100 different theories on this. There's the Elliott wave theory, there's candlestick charting. Come up with something that you can follow and that you like. I do a lot of candlestick charting myself. You can apply a lot of trend analysis to those sort of things. And you want to take a riskier bet, figure out a way to look for an opportunity for an extreme in something like the S&P index, and then buy it or sell it. Go short it if it reaches an extreme. I had a $20 bet with I'm on the investment committee for the bank. We have several portfolios. They're all in fund type products. The equity, there's one loudmouth equity guy. The other equity guys are all the same. He was very adamant about what the S&P was doing when we got above 4,000. It peaked at 4,800 in January. It started to come off 4,800, and I remember it got to 4,600. And I said, the S&P is going to crash. It is going down hard. And he said, no, it's not. He was adamant about it. I was suggesting we take some money out of the funds, out of the S&P. We didn't. And I made a call once it got to 4,200 that the S&P was going to get that fall 600 points down to 3,600 before it went back up to 4,800 and made a new high. It's right now at about 3,850 today. It went down to 35.50 about 2 weeks ago. So he owes me $20. He was going to Venmo me. I didn't want the Venmo. I want the cash. I want to bust his chops in front of the rest of the committee. But looking for those extremes, basically, I said short the S&P at 4,800 when it was coming down to 4,600. Why was it coming down? What were the technicals saying? What was going on in the market? That was when the Fed started to finally change their tune about rates and what they were doing with the economy. But understanding those kind of things are key to being able to make those decisions. So, long answer to a short question. Yeah, there's things you can do. How much risk do you want to take? Anybody else? Sure.
Do you think it's safe to say like this recession is a low recession?
100%. There's even arguments now that we're not in a recession.
What do you think?
I think we're in it. I don't, two quarters of negative GDP is an accepted view until that's one of the things that happens these days. This is insane to me. People change the definitions of things depending on what their narrative is. I mean, I went through my entire career up until about a year ago that 2 quarters of negative GDP is a recession. Suddenly we have 2 quarters of negative GDP. Like, well, that's not really a recession. Well, why? Because somebody doesn't want to call it a recession. Feels like a recession. I'm thoughtful and wary. I think, like I said, I think the stock market is going to go back down. I think we're going to make a new low below that 35.50 level we touched. I'm targeting somewhere around 3,200 in the S&P. If it gets there, I've got capital that's going in personally. Waiting till I see the whites of their eyes, so to speak. I think the housing market's going to crash. You look at the economic data, look at the CPI, which is the accepted inflation indicator. We're at 8.1% inflation. There's some places in Europe that are double digits, 17% inflation. I think England just went to 11% inflation about a week ago. That's hard to stomach. That's damaging to people's pockets, wallets, pocketbooks. Debt's going up. People are borrowing more money on credit cards. Savings are going down. These are all, to me, classic, precursors or excuse me, middle of recession, things that happen. So I don't need 2 quarters of GDP to tell me there's a recession. So, you know, if you look at things like rents right now, so housing prices are coming down a little bit from absolutely insanely peak levels, but mortgages are through the roof. So young people, the 25 to 35 demographic that might be buying homes right now are not really buying homes. So what's that mean they're doing? Well, they're still renting. Well, so the people that have been coming out of colleges for the past 2 years that are looking to rent that apartment for the first job, they might be in the city or somewhere else. Well, now they have other competition because these people that might have moved on over the past 2 years have not. They're still borrowing. They're still trying to figure out their next steps. They can't afford to buy a new home. I saw, I wish I had the number off the top of my head. I read an article and it talked about the value, the mortgage 3 years ago on a $650,000 home, which is, they said it was just the average home in a certain area, was, I don't know, let's call it $4,000. The same $4,000 mortgage now would get you something like a $280,000 home. I don't know, it's something stupid. I might have the wrong number, but nowhere near a home that I know anybody lives in. You can't, not in this area. You can't afford those. I mean, you can. If you can, it's not a nice neighborhood, and you know, it's a challenging environment, et cetera. So, those sort of things are telling me that we're in a recession. It's going to get worse before it gets better. How do you come out of those? Are the keys? Buy the S&P low. Wait until you can buy that home. You know, wait for interest rates to come down. They're going to come down. So the Fed is raising interest rates right now. Here's the interesting thing. The Fed funds rate is an overnight lending rate. It is the rate that the Federal Reserve uses to let major banks borrow money at the Fed window when they need to borrow money. So that isn't literally today to tomorrow. They borrow the money tonight, they pay it back tomorrow. That sets the tone for all sorts of interest rates going forward. Then you extrapolate, you create forward curves, you create longer duration type of maturities, you get into different products. LIBOR is no longer a thing, but SOFR is the new LIBOR, which is an indicator of longer term interest rates. All those things compound to be, what is the 10-year treasury doing? What is the 30-year treasury rate doing? What's happening in the UK gilt market? There was a craziness happening with pensions in the UK about 3 weeks ago. Read up on that. That's a liquidity crisis if there ever was one. It was very brief. The Bank of England stepped in and said that they were going to buy the UK gilt, which is, the gilt is a bond in the UK. And they were going to buy the long end of it because pension funds were going to have to dump gilts into the market en masse. It would have been the same thing, running for the exit, that liquidity issue. So those sort of things come into play. The challenge that I see is, you know, how do we bounce out of this? The Fed is going to finish hiking rates at some point. They're going to start cutting rates to help the economy eventually recover from this current / pending recession. Once those rates start to come down, then housing will become more affordable. People will be able to save more money. Those little things start to add up and compound. But in order to get to that point, you know, we need to see the bottom, and we have not seen a bottom, in my opinion.
You can stock market will go down and then go back up.
Correct. Yeah. Went to 4,800 down to 3,550. We're back up at 3,890. This is, I'll get you a second. This is what I call it's a classic bear market rally. So we're in a bear market in the equity market. Prices are going down. Prices go down hard some days, but net, the trend is lower prices as you're looking at a chart. The bear market rally is when it bounces off of that. There's something called a dead cat bounce in the stock market. So here he is. You go to a high building in the city, you take a dead cat, so it can't land on its feet. You throw it off the building. Even a dead cat, when it hits the ground, is going to bounce. There's all sorts of like odd things in Wall Street that occur like this, sort of phrases that people use. So the dead cat bounce is, even the market's going to hit a bottom and come off it really hard, but it's going to keep going down. So bear market rally is the bear market we're in. Prices are selling off, values going down. it reaches a point where suddenly people start going, I think it's over with. I think we're okay. I think we're going to buy this market now. So that's what we've been doing from 35.50 on the S&P up until today. But net, the longer term trend is still going down and down and down. It's going down like this. Lower lows and lower highs. A bull market is higher highs, higher lows. So the chart goes bull market, it goes up to a high, comes off a little bit. Still above the previous low. Up to a new high, above this one, down to a low, but above this one. Classic bull market. Bear market is the opposite. So I think that you had something.
We know also young and over having like capital to take advantage of like this, we have any advice that we can have our own like financial advice, like on our spending, maybe come back on certain things like we take it, try to build that capital.
Yeah, I want to be careful and not sound condescending on this, but I didn't have cell phones weren't really a thing back when I was in college. Didn't have I'm always a late adopter of technology to begin with. I didn't have my first cell phone until after they were already out for a while. And there were the little flip phones with the little numbers, and wasn't the new smartphones we have these days. Anything you can do to be smart about it, my father-in-law is about that tall little Italian guy, barber. I said, picture an Italian barber. That's my father-in-law. Every day, he's got a super heavy, thick accent. He's off the boat from Italy. Every time I go to work, every time he'd see me go to work when I was like, he'd be visiting or something. He'd good job, Chris. You take a coffee. You don't buy the coffee. You take it a coffee. A lot cheaper at home. Where can you save the money? Bring your lunch. I bring lunch. Not always. Sometimes I forget. Sometimes I'm out partying the night before. Don't feel like doing it. But any little thing you can do to kind of scrimp and save, and then have a plan with that money. We don't plan to fail. We fail to plan. You don't get up in the morning and be like, you know what, today, let's figure out what I can do to fail today. What can I do wrong? If you have a plan, you're going to be better off. So I don't care if it's $1, what can you do to save that money and do something better with that? Put it in the cookie jar, what have you, little things like that. When I got to the point where I could start saving my money, it took me a while in my professional career. But I would do things that I set a goal for myself to save a certain amount. And I'd get to the end of a week and I had $20 in my pocket to get through the next week. It wasn't a lot of money then even. I had to get on the subway. I was living in Brooklyn at the time to get into Wall Street. 2 subway rides each day back and forth. So that left me about $8. How was I going to get through on $8 for that week? Well, I wanted to increase that. So the next time I got to the next week, I was like, well, that wasn't fun. I'd rather have $30 in my pocket than 20. So how did I save the extra 10? What did I do in that regard? So those little things build a value proposition for yourself. And you can open up an investment account now. You don't need a lot of money to do it. Figure out the minimum. See if you can open that Fidelity account now. That's an idea, I don't know the right answer. Might not be right for you. Might not be right for you right now because you can't afford that even. I understand that. I was that guy. But what can you do to figure it out and get to that point is integral to your future success. Building those good habits is key. There's a Marine Corps. I'm not a Marine, but my father was. But there's a Marine Corps saying 7 P's. Proper planning and preparation prevents poor performance. Plan ahead, have an idea, have a game plan, figure out what you're going to do. What are you going to do next week to be better? What are you going to do to a month from now, a week from now, a year from now, 3 years from now? What's your plan? How are you going to do those things? Hope that helps. Go ahead.
Out of all the foundation concepts, I
I can't say honestly, no. I'm skeptical on Robinhood. I think what I saw going on with the meme stocks, the AMC and that kind of nonsense, to me is just, you know, people positioning for some agenda other than what is the reality of what's going on with, you know, a company or an opportunity. So I'm skeptical of that. I think, you know, like I said, I have a Fidelity 401k. I have my money with Morgan Stanley Advisor, and he does all the heavy lifting on that. But my Fidelity account is easy to use. You can buy and sell relatively easily on the app if you're in that mode. Mine's a 401k, so I'm not actively trading it. But from what I've seen, you know, those kind of Fidelity's got a decent one. I would take a look at that. Anybody else? Okay. Well, thanks for having me. Appreciate it. Thank you. If you have any follow-up questions, you know, let me know. I've got cards. You can reach out to me. You know, think of something intelligent. We can have that conversation. You know, I can be a resource here. That's why we're doing this. Thank you.
Thank you so much, Chris. All right, just a quick little reminders of tomorrow. We're having a meeting. Wis & Co will be coming in person. It's in Mansion 12. It's also virtually via Zoom. The links are on our Instagram page and our link tree. And then, yeah, make sure you get the QR code in the back to get your PDP points. And yeah, so with that, guys, that's it. Take home these flyers. You guys can keep them. It's for you guys. And yeah, if anyone's else has any other questions, that's it. And we'll see you all tomorrow when we have Wis & Co come in. Thank you.